Hi, this is Jim Welsh from macrotides.com. Thanks for tuning into this podcast. Hardly a day goes by that I don't hear some financial expert on Bloomberg or CNBC say, markets are a discounting mechanism. And by that they mean that markets anticipate changes. And if we as investors only learn to listen to the message of the market, we'll become better investors. I believe this notion is best described, as my Irish mother would say, as malarkey. Now, some of you may not be familiar with that term. It means speech or writing designed to obscure or mislead. So you say, well, why do people still believe, Jim, in markets discounting the future? Part of it is just human nature. We use logic to understand the world around us, and certainly financial markets. And we need to know why and understand why and what's causing a market to either trend up or down. When I say market, I'm talking about stock market, bond market, gold, currencies, any market this process applies to. And as the trend begins to continue, more people learn the reasons why the trend has been in place. They jump on board, and obviously that drives prices up. And because the fundamentals are still constructive and aligned with the trend, they then conclude that the market has discounted what's happening. Bull markets end when there aren't enough buyers left to push prices higher, even though typically the news is still positive. More often than not, what happens is a top takes months to unfold and build, and then slowly but surely the news starts to turn a little bit more negative and the market starts to head south. As the prices decline, investors who were in the market begin to lose money after waking up at 3 o'clock in the morning, down over 20% or 30%. They can't take it anymore, and they capitulate and sell. So what happens at a bottom is selling exhausts itself, and then the market begins to rally. And it's only months later, typically, that the fundamental news starts to become less bad and ultimately good. Again, this makes people believe that the markets have discounted the future. One thing to remember, greed versus fear. Fear is a much stronger emotion, which is why bottoms usually are compressed in time, whereas tops very often take months and months to unfold. So, still think discounting mechanism is an applicable investment strategy? Here's a couple things to consider. When the S&P recorded an all-time high in October 2007, was it telling us that the economy was in great shape, there was nothing to worry about? No. In March of 2009, as the S&P was plunging, was it telling us that Armageddon was right around the corner? Or the longest business expansion in U.S. history was about to begin? In September 2011, gold was over $1,900 an ounce. A lot of people were saying, yep, hyperinflation is right around the corner. That's what gold is telling me. And here's my point. Markets are wrong at every major top and bottom. I believe contrary opinion is a much more valuable investment tool than believing that markets discount the future. I'll lead you with this quick story. You're driving in a car with an expert, and the expert's driving. After a while, you notice that the expert is driving the car by looking through the rearview mirror. Concerned, you ask him why he's not looking ahead as he drives. He replies that there's nothing to worry about since he can see the road driving on is straight. The expert believes that the straight road he sees in the rearview mirror is discounting the straight road ahead. By the time the curve in the road appears in the rearview mirror, the car you're in is hurtling toward an unwelcome outcome. So, the trend is your friend until it isn't. I hope the next time you hear an expert talk about market being a discounting mechanism, you'll remember this podcast. Thanks again for listening, and may good things happen for you today.